Hi, my name's Kristof Gleich. I'm the President and the CIO of Harbour Capital Advisors.
My name is Morten Springborg. I am Thematic Specialist at Sea Worldwide. I have been with Sea Worldwide since 1999, both as a portfolio manager and more recently since 2015 as responsible for our thematic research.
And this is Views from the Harbour. So this week, we're joined by our first external guest. So Morten, thank you very much for joining us today.
Thanks for inviting me.
Quick bit of background on Morten and Sea Worldwide. So Sea Worldwide are a partner manager of ours. They run specialized, concentrated international stock portfolios. And Sea Worldwide and Morten are actually based out of Copenhagen in Denmark. So we thought we'd do a little international take on this week's Views from the Harbour. So what we're going to cover this week is we're going to start off in Europe. What's the latest situation? What's happening? What are you seeing on the ground? I then think what we'll do is we'll transition into really energy. It's hard to escape the energy situation or the crisis, and how that's going to impact the energy transition that's going on at the moment. And then I think what we'll do is we'll look at where you're finding some opportunities in the international landscape to drive value for clients. So let's start in Europe. What's your take of what's happening? Where are we at the moment? What's happening on the ground?
Well, I guess Europe is the epicenter of the energy crisis. Europe has, as everybody now understands, had an extreme overdependence on a very unreliable energy supplier, namely Russia. And the transition away from Russian natural gas and oil supplies is problematic. And it has led to Europe now switching away from Russian natural gas to importing primarily from the US liquefied natural gas, LNG, but at a significant cost. So I would say that on average, probably we've seen that the landed natural gas prices are up almost 10 times compared to what
10 times.
Yeah. So yeah, we have managed to fill up storage capacities in Europe for the winter. So I'm not particularly worried about that, that we should run out of gas and we would see blackouts in the electricity sector in Europe. It's a risk, but I don't think it is a significant risk. But the cost to the economy is tremendous. So we do some calculations that shows that the overall cost to the European economy from energy has gone from 5-6% to 15-16% in the third quarter of 2022.
Wow.
And that is such an increase that it is totally devastating for the ability for the economy to function. Just to relate that to the US, the energy cost to the US economy is between 5 and 6%. So you have a tremendous advantage in the US because there's an energy abundance in the US compared to what we have in Europe. You are energy independent, while Europe imports energy, and the marginal cost of imported energy into Europe is extremely high, and the marginal price of natural gas determines electricity prices in Europe. So my home in Denmark is now going to see this week electricity prices that are probably 10 times higher than a normal electricity price.
So there's been a massive redistribution of GDP towards paying more for energy. It's not like GDP has grown to compensate for this.
Yeah. It's squeezing out.
It's squeezing out consumption, investment in other areas of the market. And in terms of the energy crisis, you talked about some of the root causes, the over-reliance on Russia for natural gas. How does this play out? Is this, you said you're not that worried about this year in terms of blackouts, they've substituted enough from US exports, but are we still going to be talking about an energy crisis in 6 months from now, 12 months from now, 5 years from now? What kind of time horizon are we talking about?
Now, we should understand that the Russian invasion of Ukraine, yes, it accelerated the timing of this crisis here, but the underlying reason for why we have an energy crisis is not Putin. The underlying reasons is that we have, since at least 2015, significantly underinvested in energy because of the transition towards a decarbonized energy system.
And that underinvestment specifically in Europe, or are you now kind of talking just globally?
We talk global.
Okay.
So energy markets are global. So when we entered 2022, we were actually, and this was without the knowledge of the invasion of Ukraine, we were expecting that 2022 would be very, very critical because we saw an undersupplied energy market globally of approximately 2%. And that undersupply, given the current trajectory of investments and demand, means that by 2026-27, we could imagine that the energy markets would be undersupplied by 10%, which has never happened before.
Wow.
And the only way that you can have a balance in an undersupplied energy market is, of course, that you have demand rationing by having prices much, much higher. And that is what is happening. So we need to understand that in order to long-term have a solution for this problem here, we need to invest massively more than what we have done.
So just to make sure I'm understanding that, the situation, the invasion of Ukraine isn't necessarily the root cause of this. It actually traces way back. I mean, you could almost argue that what's happening in Europe is more a symptom of this energy rather than the cause of this energy crisis. And actually there's been this deficit of capex in bringing on new supply driven by this energy transition.
So we have wanted to increase the investments into renewables like wind and solar, while at the same time restricting the investments for the fossil industry. But we have not scaled up the renewables to compensate for the decreased investments going into fossil, and that's why we have an energy crisis today.
And when you talk about the 10%, so coming into the year, you forecasted roughly a 10% deficit by 2026, which is impossible to overstate. That is enormous.
It is enormous
in terms of energy markets. And you talked about really price shocks being the lever that then kills off demand. Because ultimately energy markets have to be in balance. Like it's physics 101.
Absolutely.
You can't use more energy than you're creating, etc. So they're going to have to come in demand through these price shocks. So do you see the spike in volatility in energy prices, in inflation, in commodities more broadly, in sort of physical assets as structural rather than cyclical?
It is a structural situation for the 2020s that we will have an undersupplied energy market. And that is going to create a lot of volatility in all economic metrics. Right now, because of these extremely high energy prices, we are seeing demand destruction. We're seeing lower economic activity, primarily in Europe, but I think it's also going to be visible in China and to a certain extent also in the US. And this lower demand, of course, will be what is balancing energy markets. And when we then look out further, when we get to the other side of what we expect to be a recession in Europe, we will see that economies will start to recover, but only to a certain extent, because there's going to be a physical cap for the ability to access energy.
Wow.
And that means that the model, the way I think about the 2020s is it's going to be short cycles, it's going to be a volatile...
Short and more volatile cycles.
Yeah, because of this deficit in energy markets. And that means volatile GDP, it means volatile interest rates and inflation rates.
And energy almost being that upper cap to kind of GDP growth. It's really interesting because we've really over the last 20, 30 years, I think, lived in a world increasingly of financialization of the world, the globalization of the world, the digitization of the world. But actually what you're talking about is it's a very physical phenomenon. You know, despite central banks' best efforts, they haven't figured out a way of printing, you know, new atoms or printing new oil or printing new natural gas. They can print money and solve financial problems, but these are profoundly different problems that we've had to face in the past.
And therefore, we believe there are opportunities for the long-term investor that can help to solve this issue here. We see good opportunities in the whole LNG value chain.
Yeah.
Natural gas imports by ship into Europe. We see opportunities in industrial gases. We see opportunities in renewable energy to a certain extent. But the world has to recognize that renewable energies cannot fix this. We cannot transition to an energy system that is over-reliant on renewable energies. We also have to accept that fossil fuels are going to be a significant part of the overall energy system for a very long time to come.
And so transition fuels like natural gas are going to have to play a key part in transitioning the world to get beyond fossil fuels, but we have to acknowledge some of the practical realities and the real problems that we have to fix, these engineering problems. And I know you've written recently as well about the role of nuclear, and I think we need to grow up and have another debate on nuclear. So maybe just a thought on what you're thinking there.
Well, first and foremost, why should we have more natural gas is because we want to push out coal. In 2022, global energy consumption is growing approximately 2.5%, but the global CO2 emissions are growing almost 5% because we are going back to coal because it's the only option we have. So we need to expand the ability to use natural gas so that we do not use the worst of the fuels, namely coal. Longer term, there is no energy transition without a stable, reliable baseload energy supply from nuclear. Nuclear is CO2-free energy baseload, and it has proven also to be safe and reliable. We have used it for 50 or 60 years, and there has been very, very few problems with it. And then if we look out only a few years' time, we're going to have new technologies, small modular reactors, and then later, when we look into the early parts of 2030s, we have high hopes and actually incredible hopes that we will start to see the first deployment of fusion energy.
Wow. Yeah. Amazing. So how, as an investor, how do you navigate all of this? I think what distinguishes you is this combination of thematic top-down thinking. What are some of these secular, multi-decade trends? Marrying that up with idiosyncratic stock selection. So as an international investor, you only invest in 30 companies. I'm sorry, it's very active. So where are you finding opportunities outside of the US at the moment?
There are massive opportunities, and maybe just opportunities that are helping us to fix these problems that we now have. And fixing it involves also massive investments. So we need to invest into the energy system. We have localization of supply chains. That means massive investments. We need to bring back production capacity that has been outsourced to Asia over the last couple of decades, to North America and to Europe, probably more to the US and maybe Mexico than to Europe because of this energy situation. And all this involves a massive opportunity for capital goods companies. And actually that is an opportunity for European companies because Europe has very, very strong capital good companies that not necessarily are exposed to problematic European macroeconomic situation, but are operating in a global environment that can tap into these investment opportunities there is, because we need to scale our investments in order to address the issues that we have.
And would automation be sort of an example of a theme?
Absolutely. When we move our previously outsourced manufacturing bases back to Europe and to the US from Asia, they will be moving back to much more automated production facilities because of the labor components need to be reduced because we're moving the jobs back, the production back to higher cost.
Otherwise that's going to be inflationary in itself as well.
Yeah, so we see big opportunities in automation technologies. That is vision sensor solutions, it is robots, it is all sorts of automation that goes into industrial manufacturing processes.
And what's an example of a name in a portfolio that sort of?
Well, we think we have a true gem in our portfolio in Japanese Keyence, which is the largest supplier to manufacturing companies, when it comes to vision technologies, they have sensors that basically observes what is happening in the production lines and helps optimize production. The payback times for customers buying these products is measured in months.
Oh wow!
And the profitability of Keyence is amazing. Other opportunities are just to remind you that, for example, Atlas Copco in Sweden is an industrial leader in compressed technologies, for example, which is also going to be important. We have massive investments going into the semiconductor value chain, because there's this idea that we need to move semiconductor capacities away from Asia back to the US and to Europe and have our own domestic production capabilities in semiconductors. That is hugely beneficial for a company like Atlas Copco that supplies compressor technologies to these fabs. It is massively positive for ASML, who is the only supplier of the most advanced lithography machines that prints the semiconductor chips.
So whether it's industrial automation with Keyence, air compressors, or lithography through ASML, there's plenty of opportunities within Europe to play that benefits from some of these macro themes. Now, a question that we often get is around our views on emerging markets. And you've mentioned throughout a lot of your comments, really, the shift away from Asia back to the West. Is it unfair to paint Asia as a region with kind of one brush? For example, investing in China versus investing in India are going to be very different. How do you think about that? Is China investable today? And what are some of the opportunities you see in emerging markets?
I think there's going to be investment opportunities in China, but we are currently not exposed to it. We think the risks are a little bit too big, or at least our visibility to what is happening in China is low. But this whole concept of what the Chinese call dual circulation, which is basically them reducing their dependency on the US and bringing up their own production capabilities with Chinese technology, probably is a very, very interesting investment opportunity that we certainly are looking at. But if I should highlight one area where we are extremely optimistic, it is India. We have invested in India for almost 20 years. More recently, we have actually hired a dedicated portfolio management resources in order to understand what is not only happening at the largest company level, but also in the mid-cap segment and the small-cap segment of the Indian equity market. Because we think that India is an idiosyncratic opportunity. It is uncorrelated with what is happening in the world because of profound reform efforts by the Modi government over the last 10 years is transforming India and actually leapfrogging Indian society in many ways ahead of what we're seeing in the West. For example, when it comes to digitization of the Indian society, the opening up of the financial services industry for not only the top part of the population, but for the 1.4 billion people.
What's an example of a name that you would invest in India off the back of some of what you're talking through?
We had a meeting back in 2001 or 2.
Okay, so 20 years ago.
There was a small bank that came to our offices in Copenhagen and said that they thought that we should look closer at them. The name was HDFC Bank, a mortgage bank. It's a mortgage loan provider in India. And we don't have time to go into the details, but basically, to begin with, we really didn't believe what they were telling us because it was too good to be true. So we spent a couple of years actually assessing this opportunity here before we bought it back in 2004. And we've had that bank in our mortgage lender in our portfolio ever since. And it has been a tremendous investment because India has developed over this time. At the time of purchase of HDFC, mortgage loans in India was 4% of GDP. That is now 10%. Just to remind you, the levels of the US is 60, 70%.
And in the UK, roughly the same?
Yeah, in Denmark it is 100.
Okay.
So It was an easy story to tell and to build conviction about that the mortgage penetration of the Indian economy would rise.
And it's gone up 2.5 times, but it's still at only 10%.
And the Indian economy has, right now, it is growing nominally above 10% a year. So we are very optimistic that what we've seen from HDFC over the last 20 years will also continue the next 10 years.
Makes a lot of sense. I think it's a good opportunity for a skilled stock picker and a good real representation of active management, of taking that long-term time horizon. You mentioned 20 years ago you first met them, you spent 3 years getting to know them. You've held it in your portfolio for 18 years, and it sounds like it could be a name that you could hold for another 18 years.
Yeah.
So my last question is, the world feels profoundly uncertain today. Yeah. There's just a lot of change. You've touched upon a lot of this. Just in your professional career, you've been investing for decades. Is it always like this, or does today feel more different at any time in history?
I think it is different today because there are so many challenges. We have very, very high debt indebtedness in the Western economies, which is challenging. But we also have this growing conflict geopolitically between East and West, between China and the US, which is something that we have to address or understand. And that means that what was with me for most of my career, ever increasing globalization, has been in reverse for the last 10 years. And it's probably going to continue with this localization and deglobalization for the remaining part of my life. So that is a different environment. But then when I look at our themes, which basically are the way that we look at the world economy, these are the prisms to the world in which we look through. We can see so many growth opportunities because deglobalization, for example, which is to begin with a negative theme.
It's negative, it's inflationary.
Yeah, but it creates huge opportunities for the companies that are correctly positioned to exploit this. And then there are other themes that basically cut through it. We have fundamental digitalization of our societies, the movement from cash to digital payments, etc., is mature, but it is not played out yet. So we still see that, for example, the transition from cash to card is going to be with us for the next 5 to 10 years.
Yeah.
Creating a backwind to companies being positively exposed to it. So the rise of emerging market consumers, primarily I would say in India, but also Indonesia and to a certain extent Brazil, Mexico, are also opportunities that we as global investors look at. So there are many, many opportunities, and I've never been more optimistic when it comes to generating alpha in this environment here.
And I think it's an important reminder as a concentrated active stock picker with 30 businesses, and I use businesses rather than stocks deliberately. You don't have to like the whole market.
No.
You can use these themes, I like that, as prisms into what's happening in the world to help you identify attractive long-term secular growth stories, to help clients deliver value over the long run. So Morten, thank you. You are, as I said at the beginning, you are our first external guest. You're so good. I think we'll even have you back if you'll come back.
I'm honored. Thank you very much.
Yeah, so thank you very much, and thank you for joining us for this episode of Views from the Harbour.